Welcome everyone to Jim Dalton's presentation, Fed Day +1. It's June 15th, 2017, 9 a.m. Eastern. We'll go for about an hour here today. Thank you everyone for being here. Top of the morning to you. We have placed we're going to put the reports in the handout section so that you have that to support Jim's discussion. And you can also, some people have a problem with the GoToWebinar interface. Please go to jdaltontrading.com, upcoming webinars, and scroll down and you'll see this post, and there are 2 reports for you, and you can download them there. S&P morning report, and last night we posted the S&P recap and preparation report. So please type your questions in, and we'll get to as many as we can. And with that, I'm going to turn it over to Jim. Good morning.
Well, good morning. Oh, hold on. I got to clear my throat. I'm sorry. I hope I missed everybody. All right. Thank you for being with us. We thought that this might be an interesting day for a webinar. Obviously, it's a promotional webinar when we get done trying to drum up more business for the second Mastery Series that starts here in just a few weeks. But it's also important. Yesterday morning, for those that got yesterday morning's report, I did something unusual. And in that report, I put a label called non-market generated information. One of the things we say is, even though we trade and we use the market profile and structure of the market, it doesn't mean that we're not in tune with the other things that take place in the market. And what I addressed yesterday was the fact that the Fed had raised rates, and yet the market had ignored that. And we were sitting at, new highs. And what it appeared was a question of, had the Fed lost control? Was what the Fed doing having no meaning? And what I wrote yesterday was a concern that not a concern, but a thought that the Fed might do something more aggressive in order to deliver a message to the traders that they were serious. And I think they did that yesterday. The rate hike was as expected, but they came out and both had a schedule for reduction of the balance sheet, as well as a fairly aggressive agenda. I think it's like 60 billion a month. So I think that was a message that, hey, we are here and we are paying attention. So then I come in and I look at this morning. Hold on, I'm going to clear my throat just one second. Then we came in this morning, and one of the topics that I outlined was the perfect storm. And as I see the potential for the perfect storm is that trade location, we were at all-time highs here in the last few days. So, you always are going to have more risk when you're at that level, and particularly because the traders have been buying every break, but they really haven't been getting a lot for that. But traders will do what works until it doesn't work anymore. So when I look at the potential for the perfect storm this morning, it was one, trade location, closing yesterday, very close to all-time highs. Secondly, the Fed action, coming up there. And then you've got the rumor hit the paper last night that Mueller's going after the president for obstruction of justice. So you had a lot of things, and then on top of that, you've got a weak oil market. And you can see oil today is down again below yesterday's low. So I said, is this the potential? Are we looking at the potential for the perfect storm this morning? So that was kind of the background of which I started to frame this morning's report. Next, I looked, and here is the range from last Friday, from the 24, I think that's 24.43 level, all the way down to the 24.1250 level. And that 24.1250 level coincides with the bottom, very close to the bottom of the last upside breakout. So when you look at this last breakout, the top of the last upside breakout. So the market really did that breakout. What's it? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, better than 2 weeks ago, or about 2 weeks ago, and it's really gone nowhere. The next thing I looked at was last Friday's total range. It is not uncommon for a market to make a substantial break, as it did last Friday, as an indication of where the market really wants to go, but it's just too early. So we still don't know if that's the case, but that was one of the things that I have been focusing on here for the last several days. So I think that is a potential, that's where the market really wanted to go, just a little too early. And the other thing we're maybe dealing with in here is, since we really don't have any excess at the all-time high, you have a little bit of excess if you look at a daily bar, but you have no excess looking at the daytime frame profile. There's no single print selling tail up there. So sometimes a market gets too long to really go any higher. And this happens in the daytime frame. We see this in the daytime frame all the time. Market gets too long, too short. But we also see it in the intermediate and in the longest of time frames, that markets just get in this case, too long to go any higher. And what's happening when that takes place? It's all these traders get long, and they're so long that every time the market sticks its head up near the highs, they're selling. Some of the weaker traders are selling. So what happens a lot of times, you have to have a fairly substantial break in the market to scare all of that weak hands money out of the market, see that replaced by stronger hands traders, so that the market then can come back and take out those highs. So that's quite common. We see that quite often. So that's maybe one of the things we're dealing with. Now, to get more specific, as we come into today, we are dealing with a gap. With about 20 minutes before the opening, and let me make it clear to what we do. The gap, as we see the gap, is from yesterday's low down to the overnight low. And I understand that a lot of people will look at the gap from yesterday's settle down to the overnight low. But we're looking at the gap from yesterday's low to the overnight low. What we're trying to see is the market out of balance relative to yesterday's range. And we are. So this morning, we are out of balance relative to yesterday's range. The larger the gap, the lower the odds that that gap will be filled on the day that the gap occurs. And the reason for that is that larger gaps trigger margin calls, and the larger the gap can reverse price-based systems, short-term price-based systems. Now, if I look at today's gap, I do not see today's gap as a large gap, because we're still relatively close to Friday's low. Now the gap trading rules are to go with all gaps that aren't filled fairly quickly, and I don't have any exact definition for fairly quickly. Normally the best short when the gap is lower is on an attempt to fill the gap where you see the tempo slowing. And, it slows as it gets, relatively close to the previous day's low. If the gap is filled, then we start to focus on value. Can it fill the gap, and can value become overlapping relative to yesterday? This would be yesterday's value area. So we would look at the overlap or be very similar to yesterday. If it fills the gap, but value doesn't become similar or overlapping, then the odds of a later break are high. And the reason for that would simply be that value was lower. Usually if a gap is going to be filled, the market will show confidence to fill that gap from the opening bell. And the reason for that is if you're going to get into there and get up into the value area, you need to be confident pretty early. So generally, if we're going to fill a gap, we generally have conviction right off the opening, and you can see that the market's got some determination to fill that gap. If the market, opens, goes down, stalls around for a while, the odds of filling that gap have diminished considerably. Overall, when I look at this market, come back, we are still within the range from last Friday's high at the 2443 level down to the 2412 level. So another perspective is saying this was made, that range was made last Friday, and we're still within that range. So we really don't have, as of right now, we don't have any real meaningful change relative to the last day of last week. We're still in this this trading environment. So as I'm going to turn off and open this for questions, we've got about 15 minutes till we go. The first order of business today is looking at the gap. So we say overnight inventory is 100% short. We know from what we have tracked over the years that overnight inventory has a tendency, about 85% of the time, we will see a counter auction relative to overnight inventory. Overnight trade, in many cases, tends to be carried out or conducted by weaker hands traders. So overnight inventory is short. If overnight inventory is short and we don't see a counter auction, meaning a rally, then that is usually an indication that the market is pretty weak, at least weak for today. So if the market is short, which it is, it's 100% short, we measure overnight inventory from yesterday's settle, which was up around just couple ticks above the high for overnight. So all the overnight trade is to the short side. If that is, if they don't have a counter auction, then that's a sign the market was really pretty weak. If we don't get a counter auction, meaning a rally of some substance, then the market's got a pretty good chance of coming back and taking a look at Friday's low, I'm sorry. And that's really where we would see significant change. Right now, there's no meaningful change relative to last Friday. We're still within that range. We had a day that tried to go up, and it was a poor looking day. It's mostly short covering, very prominent point of control. Price carried through overnight. And then of course they stayed on the high, but back down into that range from earlier. So there's really not a lot going on. The gap trading rules are really where our focus will be this morning. Julia, let me open it up for questions, please. Oh, I'm sorry. Let me say one other let me say one other thing. What I wrote yesterday morning about the Fed and the non-market generated information, not our area of expertise, but I have been around a few years. And what I also wrote last night is when the Fed starts to increase rates, generally what will happen is you will see that an emphasis going from growth stocks to value-based stocks. And so in other words, some of the FANG stocks you'd expect the FANG stocks to be weaker. You'd expect on a relative basis, you'd expect the Dow and the ES to be a little stronger on a relative basis. And that becomes relevant for people that do pairs trading, short the S&P and long the ES, things of that nature. And yesterday, I think you saw yesterday that the NASDAQ was weaker. And while this course, we generally focus on the ES as our platform for exposing you to the principles of market-generated information. I followed the NASDAQ all day yesterday. And my reason for following the NASDAQ all day yesterday was I wanted to see if this played out, that the NASDAQ was weaker. The other thing that was so interesting is the NASDAQ conformed to many of the same principles we look at on the ES. Almost all day until the Fed announcement, the NASDAQ had a poor low, meaning no excess on the low. And the rallies were coming from just a few ticks above unchanged. So what that was telling me that, I had weak trading money buying the NASDAQ yesterday. And of course, then as the market last night, after the announcement, the ES broke, and it closed. There's the close on the ES. So I'm sorry, on the NASDAQ. So the NASDAQ was a weaker close than was the close on the ES. Now this morning, the gap in the NASDAQ isn't very big. It's a very small gap. But anyhow, it's just an observation. I don't know if it's going to carry through or not. All right. We've got a few minutes till the opening. Let me take some questions, please. Okay.
How do you see yesterday's prominent POC influencing the gap rule?
It's what I did. I looked at yesterday as being a balanced day, and I disregarded the prominent point of control from yesterday. And actually, I actually went home with puts last night simply because I thought it was weak, and I disregarded it, and I said, okay, it's short-term balance is what I saw. I saw short-term balance. This was the value was unchanged yesterday. I saw a 2-day balance. The point of control is about the same for both days. And I just saw it as balanced. So I wasn't using it as a real reference for today. I think it pulled it back up yesterday simply because short-term traders are so accustomed to buying every break. It's worked for them for so long, and I suspect that's what happened. So I am not focusing on it today. If in fact the gap this morning is filled, then it comes back into play. But it's just like, here was a POC that was hanging around down here from the other day that was very prominent. And we got back down there overnight. So if we fill the gap, this comes back into play, and I'll just go from there. When you have a prominent point of control like this, and if you noticed how balanced it is, it's almost a perfect distribution. And when I see the distribution as being that perfect, then it's a sign of balance. And then I want to go with a break from balance. Okay? And I know that's not a perfect answer because so many times we focus on prominent points of control. I just saw the circumstances as different yesterday.
Okay. What is it with Jim's overnight value? I have the same value on all the days before, but this overnight value is not the same. It may be that yours is set to a volume-based value area, whereas Jim's is TPO construction. But if you check your settings, that may be it. And someone's making a comment that our overnight low is almost exactly the low of the 12th. Kind of interesting.
Yep. Markets go so often to references that are very visual. When you see that happen, when you see a market go to a very visual reference, that is good information because it's telling you that this didn't go down there on strong. You didn't go down here on strong money. You went down here on trading money. If you went on strong money, I mean, really serious sellers, they could care less about this. The people that notice these things are very short-term traders. So this is a great observation. Tells you that this low overnight was made by the weakest of traders. It wasn't made, more than likely, wasn't made by stronger traders. So, you know, that increases the odds that the market is too short from overnight. But those not noticing those things is very important. We spend a lot of time on the first mastery series talking about the importance of chunking. And chunking is, you know, the way we explain it. When you first back out of the garage, you're very careful and you go slowly, you look over your shoulder multiple times. The more you do it, the more routine it comes, the faster, the smoother you do it. That is called chunking. And what I've tried to talk about is the importance of looking at a market and observing what is going on. And chunking is very important. Being able to look at a market and have things like where this low is come to your mind almost immediately. That you see them. You look, you see the low, you see the prominent point of control. You see that all the overnight inventory is short. You see where yesterday's low is. You see the relationship of the last trade to yesterday's low. That's the more experience you get, the more chunking becomes important to have a perspective of what is really going on where you're doing it in a relatively quick and easy manner. Good observation. Julia, other questions?
Which expiration and which week options did Jim use? You said you were long puts, since there is no week 3 for June for the new SEP contract.
Actually, I extended it to the end of the month. I used the end of the month, and I used the 24/20s in there. But I came out of the trade. Before we started the webinar, I was saying it's very strange. I had a trade on overnight, and I didn't wake up once. I woke up this morning. I looked at it, and I took them off for a couple of reasons. One, we're going to be doing the webinar this morning, which has been costly for me a few times because I find it very difficult to interrupt what I'm doing with all of you to work on a trade. But I looked and I said, we're still within the Friday's range, and overnight inventory was short. I said, well, I'm just going to step aside for what it was. It was a nice pickup, and I said I'll just put it aside for now. But I did. I extended to the end of month.
Okay. Today is settlement on the 12th trade. Not sure what.
Yeah, it's stock settlement. Hold on just a second. I got to clear my throat. Now, I'm not sure. I'm not sure I don't pay attention to those things. You can get too many, you can be looking at too many things that can mess you up. Okay. Julia, you with us?
Yes, thank you. I was talking to myself on mute. I missed course 1 or the series. Can I still register for course 2? I have a fair understanding of market profile. You can. I don't believe, and we don't have plans to do another mastery, this high-touch 5-week intensive program format. So we're currently in the preparation phase of course 2, which will extend through to the beginning, the official start of course 2 on July 10th. So if you'd like to talk with me about it, of course, give us a call or an email. For right now, we're issuing 2 daily reports. You get a flavor for those reports here. You can download them at the member site at Dalton Trading. And Jim is on the chat at the training site, so you'd see his chats during the day. And that'll, and then we go into the full course 2, July 10th, with the morning webinar Monday to Friday, similar to this, what we're doing here. Bonds broke out of bounds yesterday. Can Jim comment on the bonds?
No, it was the real comment is that you're getting these they're the bonds right there. This may not be the exact times, but there's the breakout that's being referred to. You got a pair of very weak economic reports yesterday morning. One of the things that this market has been fighting is this, this report will be good. For example, and I don't recommend to people that you follow the economic reports. They generally, the only thing I want you to do, at least my suggestion, is what time they're coming, but don't read them because they'll probably contribute to cognitive dissonance. But what's really going on in here is you're getting this evenness in these reports. Yesterday's reports were very weak. Then you turned around this morning, and this morning's weekly jobs report was good again. So there's a lot of confusion. There's a lot of confusion out there for people as to what's really going on. And my recommendation is stay with market-generated information, and you'll be far better off than trying to read the reports. So yesterday morning was a rally because you had a couple of back-to-back weak reports, and the market reacted to that. So anyhow, I mean that's the best I can kind of explain. Okay, other questions?
Not.
Okay, if there's none, then let's review very quickly. We're going to open here in just a few minutes. The overnight low is clearly a reference. The next reference below the overnight low is really going to be Friday's low. So we're looking to see, we know overnight inventory is short. If overnight inventory is short and the market doesn't give us a counter auction to overnight inventory, that's a sign that the market really was very, very weak in here. With overnight inventory as short as it is, 100%, the expectation is for a short covering rally. When the market doesn't do what's expected, the expected thing would be a correction. When it doesn't correct, that's a sign of weakness. Okay, so the market is open. I must have not hit apply. I'll make that bigger as soon as settles down here. I think it's making a change. All right. Yeah. Okay, so market's open. We're within the overnight range. We have not taken out, we did not take out the overnight low. The first little auction tried to go a little lower, tried to go a little higher. We didn't get anything. We didn't get anything immediately off the opening. It didn't drive higher immediately or drive lower. It is, the little pressure to the upside, which is expected with that much, with that inventory, that short from overnight. The initial, initial expectation is for, the market to kind of attempt to rally. As I said earlier, if the gap is going to be filled, generally speaking, the market will be pretty strong from the opening. It'll be pretty strong and it'll start to march higher. Questions as we're watching this develop?
The first scenario is go with all gaps that aren't filled fairly quickly. The ideal short is have a probe into the gap as we are seeing right now with slowing tempo and perhaps slowing volume, the white text futures volume at price there. So that's playing out right now, correct?
Yes, it's attempting to trade higher.
Fill the gap.
Right now. Yeah, we are getting the expected move right now. The expected move is an attempt with that much overnight inventory is short. So it is attempting to fill the gap. And remember I said that this is not a large gap. It's a large gap if you measure it from last night's settle, but that's not what we do. It is not a large gap when measured from yesterday's low. So this isn't one of those gaps that triggers, a lot of margin calls and triggers a lot of price reversals from price-based systems. So we're attempting to go higher. So the first thing that you didn't see happen, you didn't see if the market was really, really weak, the market opens and it trades lower almost immediately. So that's the first thing that didn't happen. What the market is doing right now, it's reacting to 100% short overnight inventory.
The NASDAQ didn't get the opening strength. Can we look at it? You're still on M though?
I have a tendency to stay on and stay on it till the last day, because when I trade the options, I usually trade the nearbys. It's updating right now. Okay, the NASDAQ wasn't quite as weak as the, the gap wasn't as big in the NASDAQ. So it was the same inventory condition, but it wasn't as weak. Okay, let's go back over to the, so what we're still seeing an attempt to fill that gap. Overnight inventory was short, getting a correction from overnight inventory. As somebody pointed out earlier, this low here was a tick below a previous low, which is an indication that we didn't have strong selling, that we had weaker trading selling. That is an important, nuance. It's an extremely important nuance because it gives you that feeling of who's really behind this. And when I see things like this, it's more of an indication. It's more of an indication that I'm still looking at trading money. Keep in mind, we are still within last Friday's range. So we have no major change relative to last Friday. We're still within that area. The market is attempting to fill the gap, looking to see if we get any real volume in here. So we haven't, the red is the heavier volume, the white is the lighter volume. So we're getting some volume in here, but we really don't know what it is yet. It hasn't backed away from it, so we're not getting sellers yet. So you got comments?
I'm late, but did Jim reference the one tick double top from yesterday and the all-time high?
No, I didn't. No, I didn't. I mean, I know it's there. Well, yes, I did talk about it because I said earlier that it's not uncommon for markets to get too long and have to have liquidation breaks in order to get some of the weak money out of the way. And as you remember, one of the things we talk about quite often is that poor highs and poor lows can be the message they deliver sometimes is that the market is too long. For anybody that's been with me for any point of time, I have said that when I first learned about poor highs and poor lows, non-excess highs and lows, it probably cost me $250,000 because, over time, because I kept thinking we were going back there. So you have to, it's always putting things in perspective. All right, so right now, we have made an attempt to fill the gap. We've got some volume up here, but it's slowed. So that it looks like there was somebody selling into this rally this morning. Okay, and we've gone 33 contracts at the high. The next reference, if this market backs off, is going to be half back. Half back is always a short-term reference markets are using. So right now, the market's attempted to go up and fill the gap. We got some pretty good volume in here, but notice that it's slowed. So again, it's awful early to tell, and it's not falling away from this. But if there's anything on the downside, then you see the market needs to get down below half back and really start to show some acceleration on the downside.
Would you consider this an attempt to fill the gap that's not filled?
If I'm trading it myself, I wouldn't, simply because it's just not aggressive enough for me. And again, remember, I have a lot more patience than some people. I'm just not that anxious. So I want to see it fall away. I'm watching the volume, but I want to see things fall away more quickly. But again, I'm fairly cautious. And one of the things I keep trying to say is that if you get this anxiousness to always have a trade on, it's very difficult. And again, and there's some people that totally disagree with me. If you did this, then you have to be out very quickly. And like I say, one of the things we always talk about is monitoring for continuation. And it didn't even get back to half back. We're trying to fill the gap again. We got some volume in here. And I said, well, we sold off of that volume, but then we really didn't even come close to half back. So that's an alert to me that there's not much there. But again, I stress so much that one of the things that I've lost over the years is this anxiousness to always be in a trade and this anxiousness of being afraid that I'm going to miss a trade. Once I broke that anxiety, it's been very helpful. Okay, so now where are we? We're still trying to fill the gap. And we're getting some extension to the upside. So this volume came in, it came in and sold off, but it didn't go very far. So there was buying down there. There's the gap. It's coming back for the gap again.
I hear Jim's logic, and I am learning from the last class, but internals are really bad. ADD is on an area under negative 1500. Hard to go up?
One of the things that we talked about with Peter Resnicek on the last joint session we had together, and I've thought about maybe doing another joint session, is this idea that Peter uses a lot of internals. And as I said the other day, I put a note out the other day on internals. It was the first time I, really made a comment about them. But one of the things that we found is there's times when internals are helpful. For example, let me talk about when they're not helpful. The other day, the market was 45-degree line on the downside, which meant the market was getting very short. And at the low, the internals were terrible. As Peter said, at that point in time, you have to use the profile because the profile was saying buy it. So sometimes, early in the morning like this, when there's a lot going on, they can mislead you. The other time, so that was very misleading on the day when the market was making the low, because it was making the low, the internals were terrible, but it was very helpful a couple of days later when the market was just kind of grinding higher, and then we got an upside breakout. And, the internals in particular, the cumulative tick, kept improving all morning. Okay, so right here, the market made a second attempt up and it failed. This one was a little more aggressive on the failure. We went down, we went up, we went down a little bit, we came back up, and it was a little more aggressive on the selling at this point. So now we are down at half back. Okay, so I'm sorry.
Is this an attempt to fill the gap, and that volume would act as resistance? And it's
yes,
an attempt to fill. Yeah. So the trade is.
If you're short now, what you want to happen, you don't want to see, this is half back. I don't think, if you've got a short on, I don't think you want to see the market back up in this area. I think you want to see the market start to get some real legs below half back. And if you don't, I mean, it can be rotational because it's been a very difficult market, but this was more aggressive on the sell-off. And now, so if you do the short, what you want to do, you want to stay below half back, and you want to start down, and you want to get that low out. You want to see that we've got more than just a rotational market in here. And that's what we have. Remember, we've had one rotational day after another. So we really haven't had that overall conviction. But right now, if you did the short with the gap, you want to see this market get down below the opening. You want to see it stay below half back, and you want to see it extend to the downside, and you want to start seeing it going after the overnight low.
Jim's half back is just the half back for the pit session. You'll see a half back on his overnight profile as well. So he's referring to the pit session right now, current range half back. Right
there, it's a white line.
Right.
This won't measure it exactly, but it's the white line.
Yeah. And so on that second attempt, when it went back up through the heavy volume, it failed and started to come back down. That's where you got an attempt to fill the gap that fails, scenario 1.
Yes. Yeah, and it was more, this is what makes it, some people sit there and say, oh, I missed it. You didn't miss it. It went up. When it came back down, there was more authority.
Yeah, you got to get on it.
Yeah, there was just more authority when it started to come back through this. It just said, this is real. And those are tough. Those are tough things. You only start to gain that via experience. You're looking at the gap. They threw you a little curveball here. You got some volume. It came down. It came back up through the high. But then but then there was just more authority, and that's when you get that more authority, that's the trade you got to go with. So many traders will sit out there and say, oh boy, I missed it. I can't short it now because I missed the high. And sometimes one of the statements I make so very often, sometimes you are better off being a little bit late in a trade as it provides more information to you. So this trade, when it came back down, it's one of these things that's developed by feel. I'm sitting here watching it and we're talking, and all of a sudden it comes through it, and it's one of those things that I just want to go click because I said, it's different. This is real. Okay? I hope you saw that because they remember, this is like a really high-powered football game. Every play is designed to fool you. Every play is designed to fool you, and it's so easy to get fooled. It's so easy to get over anxious. But then it's also so easy to say, oh, I missed it. And this was not that case. So now we got back through half back. We got back through the opening. We're down at the low. Now what you're going to see, you need to see the market take the overnight low. If it doesn't take the overnight low, then you'll see the auction begin to start to rotate back up. Let's take a very fast look. You got crude oils on the low, so it's not doing anything. You're down on the, you're down lower. You had yesterday's low on the I'm sorry, the new low below the low on the NASDAQ. And remember what I said earlier, that is to be expected. If what I'm seeing is correct, I would expect the NASDAQ on a relative basis to be weaker than the ES. Okay, so the ES went through half back, went through the opening, it's down and we new low for the day, but we haven't taken the overnight low. And the overnight low is important because it's, somebody said it's another low here, but it's also, you've got this spike, so to speak, from last Friday. So it's gotten pretty slow down here. It is not as weak as the NASDAQ. We're not that far into it, but this is as the day goes on. As the day goes on, you want to see more and more price acceptance down here. Other questions, comments?
Yes. Gap fill is to reach yesterday's settlement or the prior day low. Thank you for asking. It's the prior day low for Jim. He doesn't use a conventional gap range high of the close. He uses the low of the prior day, the pit session low.
And the reason for that is I want to see if the market remains out of balance relative to yesterday's range. That is what is important to me. Am I out of balance relative to yesterday's range? If I'm out of balance relative to yesterday's range, the bigger the expectations are for the opportunities on the following day. Just a gap from the settle, but still be within yesterday's range, that's not big opportunities in there. And I'm looking to see, trying to put in perspective. All right, so now we did not take the overnight low. We got back through the opening and we're back up. So again, one of the things we said, one of the type of things we've been seeing day after day are these rotational days. So I think right now, if there's more on the downside, I think you want to see the market stay below half back. You want to see it stay out of this volume up here. You want to start to see more extension of the downside. You want to get down below yesterday's, the overnight low and the low going back from the 12th. And also, I'm sorry, I know you're going to say something, but all of a sudden, look in the lower right-hand corner, 6:49, my time. I'm always watching the clock because I want to know what the profile is going to look like when the time changes. So when B period comes along, I want to know, I'm looking down here, I've got 10 minutes, so it's a long time till the change. But you'll see if you follow the chat comments, you'll see a lot of times I'll say, okay, 3 minutes until we get to a time change. And again, what I'm trying to draw your attention to, what is the profile going to look like when the time changes? The other day I had a perfect example out there. The market looked like it was going higher, but then the structure was 3 wide, but then it got 4 wide on the change of times, tried to go higher, and the chat comment I put out that, that 4 wide with the market only 3 wide going above it, even though price going a little higher, lowered the odds of much upward continuation and raised the odds that we would get rotation. And that's exactly what happened. They're looking at the structure, being aware of the time, knowing when it was going to change, was very helpful for allowing me to see what the market might look like, over the next couple of hours. And that really helped me. The structure talked to me and helped me understand what was really going on. And it kept me from getting too optimistic or too pessimistic, which is really important to control your feelings. So far as I look, hold on, let me clear my throat just a second. So anyhow, the market was fairly aggressive from the high. It really slowed down here. It's got that feeling so far of, one of these rotational sessions again, at least for now.
Yes, someone made the comment that it's slowing here and back in. Perhaps rotation, will develop here.
Yeah, we're back through the opening. What you wanted to see on a short, you wanted to see the market go through the opening. You wanted to take out the early morning low, and you wanted to see it aggressively go after the overnight low. It didn't do that. It had the chance to do it, but it didn't do it. So I don't see any indication in here that we have anything so far, anything other than some of the same junk that we've been looking at. Rotation, indecision. And let's go back to the perspective. I outlined it on the report. We are still within that huge range from last Friday. We're still within that huge range from last Friday. So we really don't have any change this week. And this is Thursday relative to last Friday. We're still within that, and the market's still fishing around looking for some kind of direction, and it's not getting it. Got a lot of volatility. Got a lot of volatility in here. One day we're down, then we're up, then we're down. Then we had a big rally yesterday afternoon, a break and a rally, and now we're down at the lower end. Again, nothing that I see at this point that says, wow, we really have a directional move today. It may come later, but here we are. I think the last tick was just a tick below half back. Okay, other comments, questions?
Yes. A comment about the internals that were made early in the session. Someone commented that we were negative 1,500 on the ADD. She's saying Peter also makes the point that the first 15 minutes of the internals will reflect inventory adjustment from overnight. So she's making the comment that internals are becoming less negative. So would just watch that read.
Yeah, and I think, thank you for that comment, because I think that comment ties into, that's making the adjustment from overnight. I think that's extremely astute comment. And it ties into what I said the other day. When the market was making new lows on the profile, we're seeing that it's at 45-degree line, which tells us that the shorts are getting trapped, but yet the internals were very negative. And what I wrote in one of the reports was, any of these tools, you have to know how to use them. You have to know how to use the structure from the market profile. You have to know how to use the internals. If you know how to use the right tool, and you understand that when the market was getting too short the other day, the only way it was getting too short, then the internals were going to be very negative. But you can actually use the tool together and say, okay, this is what's happening. Yeah, everybody's selling, but the point of control on the profile is staying higher. So the fairest price is staying higher. then all these people are selling short. They're getting short in the hole. They're setting up the short trap. So all of these tools have a place if you know how to use them. For another example, as you know, I'm not a technical follower, but that doesn't mean that I don't use and I'm not aware of trend lines and etc. But you can use, if you come to a trend line, you can use the market profile and use the things that were volume in order to assess the odds of going through that trend line. For example, if you come up to a trend line and you've got good volume, good structure on the profile, you got pretty good odds of going through that trend line. You come up to that trend line and your structure on the profile is poor, your volume is poor, then the odds of going through that trend line are poor. Your odds are going to be better to fade that. So I don't care what tools you're using. If you learn how to read the market structure via the profile, and remember, all the profile does is organize the market's continuous two-way auction processes. If you learn how to organize that with the profile and be able to read the market, it will help you no matter what approach you use to the market.
Jim, the Dow and the NASDAQ futures are continuing down. What does that mean for us?
Well,
want to look at the NAS while we're talking?
Yeah, it's still within, is it? Yeah, it's a gap. The NASDAQ is still gap lower. And remember what I said to start with. What I said to start with is that was what I expected. You know, that's what I wrote yesterday morning prior to the Fed meeting. That's what I wrote last night and what I wrote again this morning. If the Fed is going to be more serious and the market's going to take them more at their word, what's going to happen is you're going to have pressure on growth stocks, and you're going to see a switch more to value. So the expectation for a day like today would be for the ES to be stronger and the NASDAQ to be weaker. And as I say, some people do pairs trading, you know, short the NASDAQ, long the ES. So those things are, you know, those are real things in here. And that's why we talked about, you know, kind of an understanding beyond just the profile for what is going on in the market. So I'm not terribly surprised. In fact, let me just take a look at the FANG stocks. Sure, the growth stocks. Google down 20, Amazon down 15, Apple down 118. So that's exactly what is happening right now. Is exactly what I wrote about. You know, you're getting the pressure is on the growth stocks. The value stocks are more stable. Okay, so where are we? We've got 2 minutes down at the lower right-hand corner. It is 6:58. We've got 2 minutes until we change time. It's going to be single prints down here. It's going to be too wide up here.
Jim,
the gap has not been filled. In here, value is lower. If there's anything on the upside today, then I would expect that we will get a double distribution day to the upside. In other words, if there's anything on the upside in the ES, we'll go too wide here. We would then blow away this distribution, get into yesterday's range, and start to show some upward strength. Okay.
Jim, what do you want to look at nice volume, please? We're getting questions, you know, what is a threshold for nice volume? And if we could look at that for the turn of the new print for B period.
Okay, keep in mind, volume can be very difficult right here. Okay, volume is 363. What I look at is, and I don't have any scale other than just observation, but I know anything over about 280 is about the minimal. this 360 is pretty healthy, but understand tomorrow is quadruple witching. So you're going to get some strange things going on in these, or you have the potential with tomorrow be quadruple witching. So when we wake up tomorrow morning, 1 month is off the board, and that can bring some strange adjustments to the market. So where are we right now? Value is lower. We are still rotational on the ES. Lower value, the gap is still holding, but there really is, we did not even make a serious attempt to take out the low this morning. And you could have easily sold down there this morning. The market could have easily followed the Amazon and the Googles and those things down. It didn't do it. It didn't do it. So this is a different indices, and this is why I get all the time people that are, looking at one market to trade another market. And I keep coming back and say, that is a very bad idea. Each market trades on its own. And what I've been trying to do in the last couple of days is give you a broader understanding of the potential for the ES to outperform the NASDAQ on a relative basis. Now, both markets are down. It's just that the index with the growth is down more than is, the ES, which is, has a little more orientation towards value. So right now we have a narrow base. We have lower value, and we don't have anything that says, wow. We thought we had some selling. When we got down near the lows, it just dried up. And you're looking at it and you're saying, it wasn't even seriously going after the overnight low. One of the things for traders, too many times what traders do is they will wait and see if this is going to happen. Rather than reading the tempo coming down here, the tempo coming down here was just slow. It was good tempo here when it sold off. When it got down here, it just wasn't there. Okay, so now we have a poor high. The market is attempting to fill the gap. Once again, we do not have a full high, a good high. You can see it's been taken out. I said if there's anything on the upside now, I think you get a double distribution day.
Jim, I didn't see your screen. Did you put up the nice volume?
I did.
Okay, and someone had asked, what is the threshold for good volume?
Yeah, and I did answer. I said, I don't know what, I look at 280 is about my minimum, and I go from there. But I don't have a scale that tells you. I'm just looking at it on a relative basis.
Sure.
But I do know that, 280 is it's just nothing for the first half hour. All right, so now, as we said, there was nothing. Let me go over what the market did. The market auctioned higher today, and it sold off fairly aggressively. Came back down through the opening, and the tempo just slowed dramatically as we got down near the lows. Okay, now I'm going to change subject here for a second. We break trading down into fast traders and slow traders. Slow traders are fast traders. This was a short, and I should have come right on. This was a short for fast traders. It may have been for fast traders, because when this market got up close to the gap, if you're fat, you can make that short, and if the market doesn't move immediately down, you're out of it. A slow trader, somebody that's going to think about things, doesn't want to do this trade because if they're wrong and it goes up, they'll hang around too long. But we divide our trading into fast trading and slow trading. This was a clear fast traders. When it came up here, this was a clear fast traders, little short. You got the short right up in near the high, and you've got a stop just a couple of ticks away. It either works or it doesn't work right away. Mm-hmm. Granted, I mean, the slow trader would be okay, but I didn't see it as a slow trade. I saw it as a fast trade. I should have interrupted myself immediately. But that's the difference. When we're trying to teach the courses and go through this, we're trying to recognize that there are many different personalities and many different styles of trading out there. And depending on your personality in a lot of cases is going to determine the type of trader you want to be. And for a fast trader, I mean, your risk was what? Your risk was no more than 1.5 points or so, depending on how tight you put your stop. So a fast trade, this was a great fast trade. It's not a good slow trade because the slow trader, if it's wrong, will overthink it. If you short it here, it gets up here, the slow trader will say, well, let me see what happened. Value's lower, blah, blah, blah. The fast trader say, I either want it to hold this gap or not. Now, if you did the fast trade and you're short, you're now back to half back. Very mechanical level. So if you come to half back and you don't go any lower, then all it tells you is all you've got is trading money. If you've got anything more serious than trading money, you get through half back and you start to show some extension to the downside. Again, half back is a day time frame traders reference. You know, longer term people, they have no idea where it is. But short-term traders, they're looking at the daily high, daily low, unchanged, the opening, half back. So again, that's how that works. And there's a little something for everybody if you learn how to observe a market. And it's very important. And this idea of chunking is important also. You know, have and keep in mind, you know, this gap, the importance of that gap. You know, you're saying, okay, that's an important point. If it's only short-term traders, that's an important point. Okay. Let me take a couple more questions.
Yeah, we're going to sign off pretty quick, but I want to get these 2 questions in about trades. Number one, for going long at the overnight low, if the overnight low is not taken, you know, visualizing that the market will rotate higher, do you see, would you be looking even in a period for that scenario? It's not a time constrained observation, correct? I mean, if it gets near the overnight low and you're an aggressive trader and it's not filling, you know, it's not hitting the overnight low, is it a valid trade from your perspective?
Absolutely. When it's got slow down here, again, it's a trade for the fast trader. When it got slow down here, you say, okay, you're going long and your stop's right here. You know, but it's not a trade for the slow trader, you know, because the slow trader will overthink it. But again, you see it's rotational. So it went up to the high, it failed. Now it's coming back down again, back to the opening through half back. Again, your personality of how you trade is so important. If you are a tendency to overthink things, then you've got to trade like I do. And that's looking for 1 or 2 trades a day. There are one of the reasons that we got into this idea talking about slow trades and fast trades is that there are so many traders out there that, you know, insist on trading multiple times a day. And I said, okay, if that's just nature when we look at what people do, and, you know, I say that so much of trading losses come from people that overtrade. You know, it eats up the commissions. It takes away your mental. You only have so much, you know, psychological reserve. But what I said, if you're going to insist on doing the short trades, let's talk about how you do them intelligently. You don't do them in the middle here. You say, okay, well, I think it's going higher or lower. You do them on the edges, you know, up here. You do them on this, if you talk, and I think Juliet coined this term, you know, trading the edges. So right now you've got the overnight low and you've got the gap being filled. So the edges of that range, as she would define it, would be, you know, from about the 24.16 level up to about the 24.25 level. And If you're going to insist on doing a lot of trades for the day, you want to trade the edges. There's an edge. There's an edge. So the trade about the low was fine. If you want to do that trade, when it got down, it got slow here. You got a place for your stop. But again, I stress it's the personality. You have to have the right personality, trading personality, for that to be an attractive trade. Then you have to, what is so important is you have to know how to monitor for continuation. Jeff, I'm assuming you're with us this morning. Jeff wrote us an email and he said, you know, when I've talked about traders and trading courses before, you know, people talk about where to get in and they talk about where to put the stop. But he said, I've never been any place where somebody talks about how to monitor for continuation. And really, if you learn how to monitor for continuation, you can do a lot more trades. But any trade you do can be a more intelligent trade, because if you know how to monitor for continuation, you know, you don't have to get stuck in the trade till the stop takes you out. As I stress so often, no more than about 5% of the time should a stop take you out of the trade. You want to be in control of that trade. Okay?
Yeah, one last question. I got short when we broke new lows at 1850. And I saw it as a go, no-go level, and I put my stop at 2050, trading back through the open. I lost 2 points, but I was looking forward to break the overnight low and test, you know, the low from June 9th, you know, there at 1250 that you have marked on your chart. But I know you're in the second course here, but you'd want to get better trade location. I mean, you had an opportunity at the highs or the attempt to fill the gap, maybe not at the highs, but you wait for it to chew through the heavy volume in A period and then get some trade location with that short. But go ahead, Jim. I just wanted to.
No. That's exactly right. And I make the case, if I gave 5 people a perfect trade, each one of those 5 people will do the trade later. The first person will do it right away. The 5th person will have to see more and more evidence that it's working. And that's usually where you get caught, as being the laggard. So trade location, risk management is very dependent on trade location. This is good trade location for a short. This is good trade location for a long down here, short term. You know, you have a logical place to say, where am I right or wrong? You do the trade within the range someplace. It's very, very difficult. So right now, this low is questionable. This is again, let's go back to chunking. The low in B period was exactly at the opening. Okay, who buys exactly at the opening? That's weekend traders. So if we rally from here, you know, it's based on weekends, and this is a lower odds that we're going to hold that low. Okay, I think we're about done. For those that are in the course, the chat will be open, and I will be making chat comments throughout the session.
Okay, fabulous. Thank you, Jim. Thank you, everyone, for being here. If you are interested to learn more about the Mastery Program, we have Course 2 is starting officially July 10th, but we're in a preparation phase for Course 2 with 2 daily reports and the interday chat that Jim is doing at the Mastery training site. So if you're interested, please let us know. If you would like to review this webinar, we're going to have this recording uploaded to jdaltontrading.com, probably give it about an hour and a half, 90 minutes. And we are back with another webinar next Wednesday, so check out our upcoming webinars. That will be Let the Trade Come to You. And we don't have a webinar the following week, but then July 6th, we're going to have a webinar for how to monitor for continuation. So we're going to have a specific webinar for that particular concept Jim employs all the time and teaches. Okay, so thank you very much for being here. We appreciate your time and interest, and we hope you have a wonderful day and a great weekend. Okay, take care. Bye-bye.
Thanks.
Thanks. Bye-bye, Jim.